changing affordability guidelines, and a lot of other things. I'd say that the industry and the government is taking steps, positive steps, I think, around a couple things. One is garnishment, and they're looking at the garnishee orders that have been abused. They're looking at induplum, where actually your debt doubles, and where actually collection agencies can charge you to collect your debt. And they're looking at affordability, and I think all of those are very positive. But once again, it's not really in effect yet. It will become in effect, I would guess, probably in Q1 or Q2 this year. But I think a lot of it's positive. Some of it, we're not so supportive of.
Perhaps, Russell, just to throw one at you, I mean, speaking to Davi Root just before, just after, in fact, the interest rates had been hiked, he said that he was predicting that would be hiked again, and perhaps right up to 200 basis points. Should that happen, one, obviously the consumers would be immensely under pressure. But how does this significantly change sort of the amount of risk and exposure that consumers are going to be faced with, and the pressure that they're going to be under?
Look, if that scenario does play out, and I think it's plausible, a lot of pressure will come to bear on this market. There's no question. People have a lot of debt still. It's going to impact default rates, and that's just a historical fact. When you raise the cost of debt, the people who are servicing that debt, those costs go up, defaults increase. So I think that there's sort of two stories here. The one is the consumer story. The other is the producer story, the production story in this country. We've got a bit of a mismatch in this country, perhaps a big mismatch between production and consumption. We're running a 6% of GDP current account deficit. Government budget deficit is about 5% of GDP. Households generally use debt, corporates use debt. We need to get a bit of a better balance, I think, between production and consumption. We're in the same boat as countries like India and Turkey and Brazil. They're calling us the fragile five. Perhaps that's a bit overblown, but it's simply to say that we're countries that are consuming more than we produce, and that's got to balance out at some point. So unfortunately, we do have to take steps, whether it's through the interest rate, through fiscal policy, to start reining in that consumption habit. And trying to increase our production habits, if you like, to get a better balance in the economy. That'll support the currency, and I think will create a more, less vulnerable, volatile economy.
Jeff, are you worried? I mean, if you look at the 6 months down the line, what do you think you're going to be seeing 6 months from now?
Look, not a good sign that the government has already reduced their GDP guidance for the year and their forecast. But South Africa is going to grow this year, albeit at a very, very low pace. The banks have been pulling back for over a year now, so they're being very, very cautious in who they lend to. I don't see a meltdown. I just see continued stress, kind of bumping along the bottom, but no real positive signs that are going to say there's real improvement. Certainly for the first half of the year, if not the entire year.
And that is the outlook. And on that point, we'll wrap this conversation. That was Jeff Miller, CEO of TransUnion, and Russell Lamberti, strategist at ETM Analytics. Time now for Befriend the Trend. Befriend the Trend for today is the sharing economy. Firstly, Marc, let's start off with breaking down the concept and its potential for the South African economy.
Okay, so I was really impressed. There's a service called Airbnb, which is obviously the service which lets you rent out rooms within your house. I think Chris actually used it when she was overseas, and it's a really cool concept. You don't want to take on the risk of actually having somebody renting a full time, but you do want to be able to use your spare capacity and post your room on the internet and be able to give rent it out for a couple of hours, a couple of days, whatever it is. And the concept is really cool. In fact, it's grown so much in the US that they're now doing the same service for dogs, of all things. And that was actually just one of the trends that we looked at. People, instead of paying kennelry services, they now go and rent Airbnb for their dogs.
Well, before we get to the second part of my question, we do have a caller on the line. Hello, caller. Would you like to pose your question?
Yes. Hi there. I have a question for the gentleman there who was talking about the trade of the week.
Yes, he's right here, and you may go ahead.
Oh, okay, thanks. So, look, I think, because of Finweek, I started this investing thing, and I'm looking at adding some portfolio unit trusts or portfolio shares onto my portfolio. I've got one already. It's called Rebosis. But I was interested to hear about Capital Property Fund. So I looked it up quickly, and the share price has been pretty flat over the last year. I don't know how it's going to change over this year, over the next few years. I'm also interested in terms of how will the interest rate hike impact such stocks, because I listened to a lot of comments after the announcement, and a lot of people were saying that property will be hammered going forward. So I just wanted to know what sort of what that means. And lastly, just maybe a funny thing aside, and I was talking to some gentlemen who were saying that inflation is likely to go up, and when it does, there's a likelihood that even the e-tolls will have to go up. I just wanted to know if that's maybe possible.
Okay, thank you so much for your call, and especially your 3 questions. Let's first take the first 2 to Marc, and perhaps Jeff, since you're still here at the desk, we'll throw the e-tolls and inflation question at you. Marc, there we have Capital Property Fund. Gentleman wants to know the performance outlook. Why are you positive about them, but in particular the impact of interest rates on the stock?
Yeah, I mean, repeating what we said earlier, it's not great for listed property at the moment. I think fundamentals are still tough. The thing about Capital is that it's got very niche properties within its portfolio. The thing that with listed property at the moment, I think you can still get a distribution yield of between 6 and 8%, depending on which segments of the economy. If you're looking at it, capital growth on equities at the moment looks pretty poor as a short-term outlook. If you can bank 6 or 8% before you started, then that's not bad going after tax.
Not bad going after tax. Let's move on to inflation, Jeff, and the likelihood that this is actually going to impact on e-tolls. Do you cover e-tolls by any way when you look at the index?
No, we don't. We don't look at e-tolls. E-tolls aren't reflected in our database. We get information from the banks in the formal lending sector. I mean, from putting pressure on consumers, e-tolls will absolutely have an impact. Whether or not the weak rand and other things actually change what the e-toll rate is, I'm not a magician. I don't really know that. But I think e-tolls will make a negative impact on consumers, especially given all the other things happening in the economy.
Very quickly, Marc, before we go back to break, we're talking about the sharing economy. What are the successful business models that seem to work?
So Airbnb's taken off, and it's actually gone to the point where the traditional hotel services are actually challenging the idea that you can have the so-called sharing economy. I think it's quite disruptive by nature. Property rental is a very good one because it's something that you can naturally share. Business resources, business property space, there are a couple of options there. I think property and rental of property space is the most obvious and easiest to look at.
So it's definitely a trend that you think one should be befriending in South Africa?
I think that there are opportunities there. I think you've got to think like an entrepreneur and think on your feet if things are tough at the moment.
Think on your feet. You remind me of Muhammad Ali. I expected you to start talking about stinging like a bee and dancing like a butterfly. But on that note, we're going to take a short ad break. After the break, we'll discuss some residential letting trends for 2014. Do stay tuned to CNBC Africa. Welcome back to Finweek Money Matters. Now, South African households remained under severe financial pressure due to a weaker rand, rising food and fuel costs. The recent interest rate hike will result in many home buyers having difficulty raising bond finance, which will further boost the demand for rental property. Finweek looks at property letting management trends that will prepare both landlords and tenants for 2014. Joining me now at the desk is Michelle Dickens. She's the founder and MD of TPN, and Glenn Norton, broker and owner at Remax Masters. Thank you so much for making the time to join us. Michelle, maybe let's start with you. I mean, I picked up an article here that says there was a TPN survey released last year that said there was a growing supply shortage in the residential rental market, and now on the back of this interest rate hike in particular, have you begun to see the turnaround, or is it just way too soon for now to start seeing maybe in a few months from now?
Sure. So we're still seeing a rental supply shortage. There's still an over-demand of tenants looking for properties. The problem, of course, is that not all of the tenants are well qualified. So although we have a high volume of tenants looking for properties, stock is short short, and qualified tenants are scarce at the moment.
Glenn, maybe some context for us for this discussion. What's in demand at the moment in terms of stock from a property, a landlord looking to buy property to subsequently rent on?
All right. From a landlord's perspective, there's a huge demand. Okay. From a tenant's perspective, our most popular price range right now is most probably between 6 and about 12,000 Rand, your lower middle segment. From a landlord's point of view, your best investments to buy generally are 2-bedroom, 2-bathroom units. We find that they rent out very quickly. You might have a young couple, you might have 2 ladies sharing or 2 gentlemen sharing, so they split the rent, it makes it more affordable. We also find that your return from an investor's point of view is very, very good in that particular segment.
Do you think that's about to change now that consumers are under more pressure? Do you think the 2-bed, 2-bathroom would maybe not be as popular anymore in a few months?
From our personal perspective, you've got to remember that it depends completely in your price sector and also the different areas that you are dealing in. But the bottom line, okay, is that the majority of people that actually rent, okay, are young people, youngsters, starting out, just starting their first job, and so on. And with the new bank regulations requiring deposits and that, they're actually forced to rent. So because they need to save up either a 10 or 15 or 20% deposit. So that's the first part of it. The second part of it is that a lot of people during the economic financial crisis, okay, got impaired credit ratings, so therefore they actually do not qualify for bonds. So therefore they're forced into the rental market, and this is what is actually fueling that particular demand.
Michelle, I want to take that because I want to throw it back at you. Is that the reality? I think there's a perception out there that banks are not giving bonds anymore. But I flipped to the other side and I talked to a lot of bankers, and they're desperate for, they really are trying to find people to lend to. Is there a perception that if I've got a bad credit record at the moment, I'm not getting a bond?
I think it's more than a perception. When you look at actual decline versus accept ratios, the ratio of declines or rejection is on the increase. So we're sitting at 57% of credit applications being declined, and that's slowly increasing quarter on quarter. Coming back to what Glenn was saying, when you look at the number of tenants remaining in properties, whereas we were seeing tenants exiting rentals at around about 27, 28 years of age, we're now seeing them exiting at 30, 31 years. So you can see tenants are in the market for longer, for a number of reasons, one of which would be the banks.
Let me jump in there because we've got a caller on the line. Hello, Zilla. Can you hear us, and what is your question?
Hi, I'm at the moment. And I'd like to find out at what age shall I start thinking about a business plan that I can put together for perhaps a clothing and merchandise business. And is there any particular subjects that I could study in terms of entrepreneurship?
Okay, thank you so much, Zilla, for your call. Very much divergent from what we're talking about, but I always have my right-hand lieutenant who can take any question thrown at him. Marc, so she wants to know. She wants to start her clothing business. Your thoughts on that and how she should approach the process?
Look, big jump sideways from it. But I mean, I'll bring it back to this discussion we're having at the moment, because I do think that consumers are under pressure. Don't go and jump into starting a business right now. I'm mind blown by the idea that somebody at 31 is still renting a property as opposed to having assets to their name. If you want to go and start a business, nobody's going to stop you. But be aware that consumers are under pressure, and in a consumer-facing sector like like fashion is likely to be incredibly expensive. It's a very risky venture at the moment.
Okay, of course, unless the person decides that instead of the fashion business, they're going to actually buy to rent as a particular investor. So maybe come back to you, Michelle, on that. Relatively speaking, how's the rental market performing to normal, say, house price growth at this time?
So house price growth is on the increase. The yields at the moment are sitting at around about just short of 10%, so 9.8% at the moment, and that's overall, and that's on our gross yields. And what I always caution our investors and our landlords, that's the gross yield. Our investors still need to take into account their levies, their special levies. Big problem with special levies in sectional title at the moment. Their maintenance costs on their properties. All of these additional expenses need to be deducted before we get to the net yield. Coming back to what Glenn said about which property an investor should be looking at, if we bring in the numbers into that, certainly our 1 and 2 bedroom sectional title properties are performing best.
Glenn, what about... Yeah, I was going to say, we were chatting student accommodation last week, and it seems to be a huge supply issue around student accommodation. And being the typical capitalist that I am, I thought, gee, this sounds quite good. What about buying around universities for that 1 or 2 bedroom type sharing agreement?
Very, very good investment, good return. We find that it works generally in a 4-year cycle. Okay, I'll give you an example. If you've got 100 townhouses, in a complex, on average your degree is around about 4 years. So very often moms and dads, they decide, you know, they don't really want to pay all the student accommodation in rent, so what they do is they invest for a period of time, and then when their children move on after the 4th year, they actually sell it, and not only have they saved themselves money, they actually get a return on their capital investment. So that it's not like they're just taking the rent and paying somebody else. A good example would be the Yard, okay, which is in Auckland Park. It's close to all the universities. We've currently got a waiting list there, right here, right now, for approximately 25 students, okay, that would like to go into that particular complex.
Let's look at the geographic makeup. I saw a very interesting article or report, I think it was about 2 or 3 weeks back, that said if you look at high net worth individuals, people in Johannesburg have the money, but people in Cape Town have the class. I think that was the distinction. And we had a big fight about that with the guys in the Cape Town studio. But geographically speaking, if you want to get into the buy to rent space, where should you be looking? Is it the typical Gauteng and Western Cape hotspots?
All right. You know, I'm quite an astute in property investor myself. I own quite a few units in that, and I generally like to invest quite close to where I actually stay because I want to keep an eye on what I'm actually buying. You can buy all over, but you've got to understand that if you need to manage the property and you need to get there, this can be a huge problem, you know, along the way. So, look, I have my hot spots that I like to buy. I always maintain inside of the ring road here in Johannesburg, in other words, inside of the N1 is always better than on the outside. You find that the closer you are to certain business locations like the CBD here, Sandton, makes for very good investments as well, but your entry level is also quite high in terms of what you've got to spend to get in for an apartment. I don't really have any areas that I think are really, really good. But what I do want to warn people about is drive around and look at the neighborhoods that you're going to invest in when it comes to buying a sectional title unit or a house for that matter. Because if the neighborhood is going into a state of decline, there's a good possibility you're not going to get a good return and you're not going to get a good return on your rental investment.
Michelle, what about interest rates? Because I think that this is topical. How are you guys factoring that in? What do you expect that to impact that's going to have?
Definitely. When we look at our data, we see a 9-month lag between interest rate increasing and tenant declining. And right now, we're seeing tenants sitting at the top of what of their behaviour levels, from a low of 71% in 2008 up to 86% with tenants in good standing at the moment, and that's the best it's ever been. So we're at the top of the peak. Interest rates go up and we're going to see a 9-month lag and we're going to start seeing deterioration in tenant behaviour.
Do you find that people sublet their houses where they live?
Not so much in residential. In commercial, that's a big part of the commercial property behaviour, but in residential, no, not at all. We tend to see that, especially with the Consumer Protection Act, tenants are afforded a 20 business day cancellation period. So they take their 20 business day, they pay their penalty, they move on.
Unfortunately, that's all that we have time for this week's edition of Finweek Money Matters. Thanks again to my guest, Michelle Deckens, founder and MD of TPN, and Glenn Norton, broker and owner at Remax Masters. Remember that you can read about these stories and many more others in this week's edition of Finweek, which is on shelves today. The magazine is also available digitally in English and Afrikaans via mysubs.co.za. Thanks again to my co-host, Marc Ashton, who's also gotten the title of right-hand lieutenant today, editor and of course he's the editor of Finweek, and Kristia van Heerden, Finweek.com editor, and we'll see if we can promote her to left lieutenant or whatever the term is. Please do follow us on Twitter. Of course, that's using the hashtag Finweek Money Matters. We'll see you again, same time next week.